Weatherford International, ticker WFRD. Second quarter 2026 revenue comes in at $1.105 billion
Right, which is down 4% sequentially.
and down 8% year over year. Plus, net income just took an absolute beating, dropping 64% quarter over quarter.
Down to just $39 million.
Yeah, leaving them with a razor-thin 3.5% margin.
Yeah.
But, and here's the massive twist in the numbers, adjusted free cash flow actually surged 64% sequentially to $139 million.
With a massive 62.3% conversion rate.
Exactly. And looking ahead, management shaved their full-year revenue outlook down to between $4.54 and $4.8 billion, mostly due to geopolitical turbulence.
Yeah.
Yet they're entirely maintaining their free cash flow conversion targets.
It is a textbook example of a company taking a heavy blow to the top line, but, aggressively defending its balance sheet.
Okay, let's unpack this, because for you listening, today's mission is diving into Weatherford's Q2 earnings presentation and official news release to figure out how a massive global energy services company navigates this kind of unexpected geopolitical shock.
While still pumping out robust cash flow and executing major strategic overhauls.
Exactly. So we're looking at the hard numbers from Q2, the segment performance, and the corporate strategy to get a clear picture of their resilience.
Because honestly, some of the most fascinating stories in business happen when macroeconomic headwinds collide with just strict operational discipline.
Yeah, for sure. So before we look at the specific services Weatherford provides, we really need to understand the immediate macro-level financial impact of recent global events. Management was very direct about the cause of that revenue and net income drop.
Very direct. They attributed the delayed activity and the operational disruptions primarily to the ongoing conflict in Iran and broader geopolitical tensions across the Middle East, North Africa, and Asia.
Which they refer to as the MENA-ANG region.
Right. And to be crystal clear for you listening, we are just neutrally reporting the company's cited geopolitical headwinds here. We take absolutely no side on the conflict itself.
No, of course not. We're just looking at how that external shock essentially stalled a significant portion of their higher margin drilling activity in what is a massive geographic market for them.
Yeah, which brings up the most glaring contradiction in this report.
I mean, you really need to understand this if you're analyzing the stock. You have net income plunging by almost 2/3.
Right.
Yet the actual cash entering the bank account, that adjusted free cash flow we mentioned, goes the exact opposite direction.
It jumps to nearly $140 million.
Yeah. If you just look at a headline net income miss, you might just assume the core business is failing.
But the cash flow tells a completely different story.
So how are they pulling a 64% cash flow increase out of a stalling operation? I mean, it's like driving a massive cargo ship through a sudden severe storm, right?
Yeah.
The overall speed, the revenue and net income drops drastically.
But the engine efficiency, their cash flow and working capital management is actually running better than ever.
Exactly. So how do they do it?
Well, it really comes down to the mechanics of net working capital and just strict capital discipline.
Okay.
In an asset-heavy sector, like oil field services, your accounting profit, so net income, gets dragged down by non-cash items.
Like depreciation on those massive rigs and equipment.
Exactly, but free cash flow strips that noise away and looks at the actual liquidity. Weatherford generated that cash by pulling very specific internal levers, starting with their receivables and payables.
Right. They managed to pull their adjusted net working capital down by 3 days.
Bringing it to 100 days of revenue.
Now, I mean, 100 days still sounds like a really long cycle for getting paid.
Oh, it is a long cycle compared to, say, a software company.
Right.
But in global energy services, shaving 3 days off that cycle is a heavy lift. It unlocks millions in immediate liquidity. Yeah, they specifically noted strong continued cash collections from a major client in Latin America, alongside much tighter payables management across the board.
Which really highlights the importance of geographic diversification. If your clients in the Middle East are delaying activity, you need your clients in Latin America to be paying their invoices on time.
And they are. That cash collection in one hemisphere is actively offsetting the operational delays in another.
But working capital is only half the equation, right?
Yeah, the other lever they pulled was a massive clampdown on capital expenditures. CapEx came in at just $42 million for the quarter.
That is under 4% of total revenue.
Barely 3.8%, yeah.
Now, looking at that from an investor's perspective, I have to play devil's advocate here.
Sure.
When I see a company slashing capital expenditures during a macro shock just to prop up their free cash flow, my immediate fear is that they're starving the future business to make the current quarter look good to Wall Street.
Right. Are they underinvesting in their own fleet?
Exactly. Are they?
Well, that's always the primary risk when you see CapEx drop that low. But in this specific environment, it looks more like targeted defense rather than starvation.
Okay, how so?
The beauty of their current operating model is that they don't need heavy speculative capital deployment to sustain their baseline revenue. They're optimizing the assets they already have in the field.
I see.
CEO Girish Salagram actually commented on the, quote, reliability and resilience of our operating paradigm.
Right.
By holding CapEx that low, they achieved that massive conversion rate. That cash generation is the direct reward for not overbuilding their capacity when the macro environment was easier.
So they're essentially proving their financial engine can run highly efficiently,
Yeah.
even when the ship's overall speed is cut in half.
Exactly.
But capital discipline at the corporate level only masks so much. Generating cash on a macro level is great, but we have to look under the hood at the specific business segments.
We need to see exactly where the pain was felt.
Yeah, and how they compensated for it. Because the impact of that MENA disruption was definitely not distributed evenly across their portfolio.
Not at all. They operate 3 distinct segments, and the drilling-focused divisions absorbed almost all of the localized pain.
Let's start with drilling and evaluation, DRE. This segment posted revenue of $291 million.
Down 9% sequentially.
Right. And the company noted this was hit specifically by lower managed pressure drilling and wireline activity in the Middle East.
Yeah, and we saw a similar structural drop in the well construction and completion segment, WCC.
Which brought in $433 million, down 2% sequentially. Again, dragged down by lower liner hanger activity in MENA.
See, when you have geopolitical tension in a region that's heavily dependent on massive, complex well construction, operators just pull back.
They delay the highly technical phases.
Exactly, because the risk profile of completing those wells changes overnight. That is exactly what hit the DRE and WCC segments.
But then you look at their third segment, production and intervention, or PRI. This was the absolute bright spot of the quarter.
Revenue came in at $316 million.
Up 7% sequentially. And the adjusted EBITDA for this segment surged by 30%.
Driven almost entirely by international pressure pumping activity. And this divergence between the segments highlights a really critical aspect of Weatherford's corporate architecture.
Well, I want to dig into that architecture because the geographic revenue split here is extreme. Roughly 81% of their total revenue is generated in international markets.
Yeah, heavily weighted internationally.
I mean, only a fraction, just over $205 million this quarter, comes from North America. Meanwhile, international is at $900 million.
Right.
If you are an investor looking at this stock and 81% of your revenue is international and regions like the Middle East are experiencing intense volatility, isn't that geographic distribution a massive vulnerability for the listener to watch out for?
What's fascinating here is that while it's a vulnerability on paper, the mechanics of how Weatherford operates actually turns that geographic spread into a shock absorber.
A shock absorber.
Yeah. They aren't just selling one service in one region. They operate 15 major product lines spread across 75 different countries.
So the sheer dispersion of the product lines protects the total revenue.
Exactly. The massive growth in the PRI segment is the perfect example of this. Weakness in one area like Middle East drilling can be partially offset by strength in another.
Like international pressure pumping.
Right. MENA is a critical anchor for them, obviously, but the global portfolio allows them to capture pockets of high-margin activity even when a primary region is bogged down by conflict.
Okay, so understanding that their operations are stabilizing their cash flow, we now need to pivot to how management is actively using that cash.
Because they're fundamentally reshaping the corporate structure.
Right. Here's where it gets really interesting. You look at the balance sheet, and their net leverage is exceptionally low.
Sitting at 0.34 times.
Which is tiny. And they're returning cash to shareholders. $36 million in Q2.
$20 million in dividends and $16 million in share repurchases.
Plus, they announced the M&A deal. They're acquiring NCS Multistage Holdings, projecting at least $15 million in synergies.
It's a highly strategic bolt-on acquisition.
And on top of all that, they're proposing a major redomestication to move their corporate home from Ireland to Delaware.
With a special shareholder meeting set for September 3rd, 2026.
So here's my question. How does a company whose net income just dropped 64% safely afford to buy another company, buy back its own stock, and deal with the massive legal headaches of moving its corporate headquarters across the Atlantic?
If we connect this to the bigger picture, it all comes back to that pristine balance sheet, that 0.34 times net leverage.
It gives them that much flexibility.
Absolutely. When you have a balance sheet that clean, it allows a company to play offense while its competitors are forced to play defense.
Okay, I see.
They can absorb the NCS acquisition because they expect it to be cash flow positive and margin accretive right out of the gate. They don't have to take on toxic debt to do it.
They're using the cash they're wringing out of day-to-day operations to buy future margin expansion.
Exactly. It's a compounding effect.
And what about the redomestication? Moving from Ireland to Delaware is a huge administrative undertaking.
It is, but the operational footprint doesn't move. The hardware, the rigs, the employees stays the same. It's just the legal framework governing the capital that gets an overhaul.
It's like changing a computer's operating system while the computer's still running.
That's a great way to put it. And moving to Delaware aligns them much better with major U.S. capital markets. It reduces the friction for large institutional investors.
Making the stock easier to own.
Right.
Okay, so having explored the Q2 numbers and these really bold corporate moves, it's time to look at what Weatherford is telling investors to expect for the rest of 2026.
They provided very specific guidance, though slightly tempered.
Right. For Q3 2026, revenue is projected between $1.105 and $1.155 billion.
With adjusted EBITDA expected between $235 and $265 million.
And for the full year 2026,
Revenue is projected at $4.4 to $4.8 billion, with adjusted EBITDA of $951 to $1,046 million.
So what does this all mean for the everyday investor listening? That full-year outlook was slightly reduced because of the Mine volatility.
Yes, but management expects a, quote, significant ramp-up in margin contribution in the second half of the year.
But contingent on regional stability, right?
Entirely contingent on it, yes.
Which makes me question the CEO's optimism. Is betting on a gradual return to pre-conflict operating levels in the Middle East a realistic financial strategy? Or is it just wishful thinking?
It's the ultimate dilemma in forecasting for this sector. You're dealing with variables outside your control. But what tells me this isn't purely wishful thinking is their cash flow guidance.
Because they kept the full year free cash flow conversion expectation in the mid to high 40% range.
Exactly. That shows management believes they can control their internal costs, even if they can't control global geopolitics.
They're controlling the controllables.
Yes.
Which leaves us with a really compelling question for you to mull over as we wrap up. Weatherford just proved it can extract $139 million in free cash flow and execute an acquisition during a severe geopolitical crisis that hammered its top line.
A true trial by fire.
Exactly. So when the global geopolitical waters eventually calm down, what will this leaner, cash-rich, newly Delaware-based entity look like?
Will this make them an unstoppable, aggressive player in the global energy market going into 2027?
It's definitely something to explore on your own. Thanks for joining us on this deep dive. Make sure you follow the show so you never miss our daily earnings coverage.
We'll get you next time.